Hello, good morning. This is Jinen Gala presenting for portfolio analysis. So in the stage 1, I had purchased Apple, Pfizer, Nike, Tesla, Uber, Wall Street, United Health, P&G, Nvidia, ServiceNow, Salesforce and Boeing. So the basic idea behind purchasing all of these stock was to cover maximum industry to just spread the beta and the risk in general, because like investing in different sectors, so like if one sector is affected negatively, so other stocks are there to recover the portfolio. So that was the basic ideology behind that. Not much analysis was done. So industries covered were IT, medical, transportation, retail, FMCG, semiconductor, aviation and automobile. So the following results of the stage 1 were obtained, which is also attached in the screenshot. So the Sharpe ratio was around minus 19.737, tenor was minus 4.006, the losses were around minus $8150 out of the amount that was given to us. So the value of the portfolio left was $91,849. So the return of the stage 1 was calculated as 8.15%, and the standard deviation of the portfolio was 0.2461. Now moving on to the stage 2. So at stage 2, one particular stock that I thought was performing very badly was Nike, as it has been declining steadily. So I sold some shares of Nike and purchased Tesla. So as Tesla was performing continuously good and the prices were steady and were also increasing, but at that time the market entire was red, so didn't make much changes, because I believe in long-term investing. So basically you need to have some patience to get some returns. So the ratio of Nike and Tesla shares were changed in the portfolio. So due to that, Sharpe ratio and tenor ratio didn't change much, but the losses were brought down to 7568 and the value of the portfolio increased to 92,431 from the previous 91,849. So basically just from changing the composition of one share, this result was achieved. So the total losses of the stage 2 was 0.63%, and the total loss during both stage aggregated was minus 7.157, and the portfolio beta was 1.2304. So to compare the two stages, the losses during stage 1 were higher than the stage 2. The portfolio was more diversified in stage 2, which reduced the losses, but the losses again were reduced, but at the rate at which it increased was also reduced. So there was no positive return during the stage 1. It was important to note that even the standard deviation increased in the stage 2 as compared to stage 1, due to which the return also increased. As the risk increased, the return increased as well. And this was obtained again by adjusting the amount of share of Tesla and Nike. And the stock price of Nike was reducing, so the weight of Nike in the portfolio was changed. The ratio that were considered was US 10-year treasury interest of 4.86, and the tenor ratio is the reward to volatility ratio, which is for the portfolio was minus 19.27, and the Sharpe is potential risk adjustment return, and Sharpe ratio of 3 and above is considered excellent, although mine was minus 3.932. And both the ratio performed significantly bad, but however the market was also feeling a downturn, so not much could have been done. So thank you.